All right, welcome back to the Dynamic Growth Podcast. Today on the podcast, I am going to be talking about an alternative option for fixed income and why moderation may not be what you need to use all the time.
We're also going to be talking about NVIDIA's recent blockbuster quarter beating all expectations, but the stock isn't reacting like you would expect. We're also going to be talking about a potential buy on our watch list. The stock is down 80% from the all-time high. It's starting to look like a value based on the fundamentals. We're also going to be talking about Bud Light's recent policy blunder and how BlackRock is changing their tune on ESG and what that means for the prospects of a Bitcoin ETF. We hope you enjoy this week's episode.
Here with Perma Bear, Derek Ballinger. Derek, you wanted to talk about NVIDIA today?
Well, okay, so I'll be bearish on one stock, and then I'll be bullish on another, so we'll even it out.
We'll balance it out. Okay, let's hear it.
All right, so NVIDIA reported earnings on August 23rd, and they raised guidance. We had talked about this. They had raised guidance for this quarter that they just reported on. They were like, the analysts were wrong by like $6 billion in revenue, which is like a huge revision upward. So they had this massive hurdle to overcome this quarter. And by like all metrics, like they completely knocked it out of the park. Like that was just a really good quarter. But just judging on how much the stock has run up, I'm just betting that there's going to be some like regression to the mean, and the fact that the stock is up 221% for the year, and basically all of these anticipations that they're going to just keep jumping over all these hurdles is basically priced in at this point. And 45% of NVIDIA's revenue comes out of China. So I mean, you can make this into a bearish argument where China is having problems with deflation, outright deflation. They're having real problems with their economy. So you could make the argument that this is like overwhelmingly bullish, because if you're focused on the long term, you're talking about 45% of the revenue coming from a country that's being like economically handicapped right now. So when those issues are cleared up, like it's even going to be better. But you could also make the case that like if the next couple of quarters are going to be worse, like because the quarter that they just reported on were for the past 3 months, and the data coming out of China has gotten worse. So in the very short term, I'm pretty bearish on the stock, especially because you see how it reacted after they reported. Like it shot up to like over 10% after hours. And then basically the next day it reversed all those gains, and it's trading actually below where they reported earnings, the price right before they reported earnings. So it seems to me like it was a kind of a like buy the hype, sell the news type of event where everyone was driving the stock up in anticipation of this beat. And then once the beat actually happened, everyone kind of is dipping out of it. So in the very short term, I'm bearish on the stock. But I mean, like the joke that I always say to you is like, I'm really looking forward to buying NVIDIA at 300, because I mean, all of 2020 and 2021, I was talking about the long-term prospects of NVIDIA. And I think all of those are overwhelmingly true, even more so than I originally thought. I thought some of that growth was going to take a lot longer to get to impact their bottom line, but I mean, it seems to be impacting their bottom line in 2023. So I mean, yeah, I'm overwhelmingly bullish on the fundamentals, but I'm not going to buy it at this price here.
Yeah, up around 270% for the year, give or take a couple percentage points.
223.
223. So it's actually come down some.
I think from the very beginning of the year, well, so peak to trough, like, because they sold off like 80% or something last year. I don't have that. So they sold off 63% in 2022, and then from the bottom to where they are now, it's up 282%.
Okay, so I think we had talked about this before in prior podcasts that, and we had this in our risk analysis that we put out for the quarter, is that NVIDIA was pricing in a lot of growth already going forward, right? Pricing in a perfect decade worth of growth,
yeah, right.
in the way that they were. So I think even though it was an amazing quarter, like you can't look at that quarter and say it was anything else but amazing.
Yeah,
But
better than an impossible expectation, you know.
But the way the market reacted, you would assume that it's basically the market saying, "Hey, nice job, that's fantastic," but we've already priced in all this growth. So, how much we can go up from here, yet to be seen. I would imagine that you're going to see NVIDIA as the demand. If you look at where the revenue is coming in, it's coming in from the data centers that they're putting up. At some point in time, I think companies are going to say, "Hey, we've upgraded. We've got our infrastructure in place here. Now it's time to do other things." And eventually, I think you're going to see that the data center demand cool off a little bit, and maybe now the shift or the focus shifts to more cloud companies, cloud-based companies. Yet to be seen, but I would imagine that NVIDIA is probably going to see. Right now, it's in demand. It's got an acceleration of growth, but eventually that will be cyclical. That will begin to cool off. I don't know if you're a trader, then obviously you would try to time the top. If you're a long-term investor, you look at a company, in my opinion, like NVIDIA. Yeah, buy the dip, right? Wait till it falls back and buy it again. So you can't say that any of this year has been anything but fantastic for NVIDIA. It has essentially driven this market.
Yeah, definitely. And then it's also it's driven the narrative. I think the narrative has driven the market, and then NVIDIA is driving the narrative. This whole like AI narrative. So my issue with the AI narrative is not that AI will eventually be everything that it's cracked up to be. All these talking points about automation, productivity. I think all those things will eventually become true, but I don't think they're going to be true in 2024. And I've made this point before. So when you're pricing in a growth rate of whatever percentage, and it's going to be they're going to be producing this much earnings, this much free cash flow in 2030, and you're pricing that in today. It's like, well, there's a lot of stuff that has to happen from now until then. One of which I still believe is we're going to have a recession. Whether it's mild or severe is yet to be seen, and we've obviously not seen that yet. I mean, the U.S. economy has beaten a lot of expectations in 2023. But at the very least, it's not going to be completely rosy over the next year just because of the point I just made with a lot of their revenue comes out of China. And I mean, we're talking about 45% of their revenue comes out of China. And China is actually performing under expectations. Like there weren't a lot of people at the beginning of the year that thought China was going to be this bad. Everyone was saying that they were going to save everybody from a recession because they're going to. We talked about this last week. We don't have to talk about this.
It was actually the U.S. The U.S. has been the shining example, and you're right. Everybody thought it was China that was going to jumpstart this next bull run.
So yeah. So long story short, I just think that it's not a clear growth trajectory that gets us from today to AI is going to bring on all this prosperity. I think there's a lot of stuff that has to happen in the meantime. And NVIDIA, I mean, just as a like being agnostic to the fundamentals of the company, it's just this narrative has sucked up so much attention that, I mean, every time this happened in the dot-com bubble too. And they were right. Like the ultra bullish people during the dot-com bubble were like, oh, the internet's going to bring in all this prosperity and all this productivity. Absolutely right. Dead on. They probably even understated it. But the stock market still sold off 80%. All those companies still sold off 80% because they got too ahead of their skis, and they were saying all this stuff has to get priced in today, but it's the process of what has to happen in the meantime.
Yeah, I'm smiling because it isn't that so much of investing where you can be right, but the timing of it is sometimes not what you expect it to be. You know, if you expect there to be cracks in the economy and you're becoming defensive, that bull run could continue on for months, for quarters,
years,
for years. Yes, yeah. Without actually, you know, eventually everything resorts back to the mean. But when that actually happens is what makes investing very difficult. And we've gotten into this before, which puts traders at a disadvantage, in my opinion.
So one thing about regression to the mean is it doesn't regress to the mean; it overshoots and undershoots. So sure. It spends no time at the actual average. It'll overshoot, and then I mean, just like this year is a good example where, or let's go back to 2022. Everyone is like, the Fed's raising rates to like 3%. People are terrified of 3%, and then like everyone was like, the recession has to happen now. So it sold off more than it should have, not anticipating 2023 was going to be better than expected. So now it's overshooting. And I'm of the general belief that I'm not saying we have to break the October lows of last year, but we're probably going to retrace. I mean, this is speculation. I wouldn't even say, like, always risk manage, right? There's probability that we keep going up. There's probability that we keep going, or that we go down. So have allocations to both scenarios. Like, don't be 100% in one boat. But I think that's a probability that just as we're overshooting now, there's a possibility that we could once again go below.
Do you mind if I take what you just said and segue into something that I wanted to talk about?
Yeah, let's do it.
So you're looking at both. The stock market tends to go up, right? It goes up more than it goes down. Yet we still risk manage. And what is a common asset class that somebody would put in a portfolio to risk manage?
Bonds, usually.
Bonds, right?
Mm-hmm.
I think it's healthy to rethink that position in an account, right? We have bonds in our models. Right now, we are full of those T-bills, right? They're not bonds, but treasury bills. We're full of treasury bills, paying 5.5% roughly. Fantastic. So if I'm going to take my stable rock portion of my portfolio and I'm going to put it in something that earns 5.5%, that's amazing. I mean, it wasn't too long ago that we had to go to a high yield bond fund in order to get a yield above 5%. Now you're in a treasury bill. But the old adage of the 60-40 portfolio, where we got 60% stocks, we got 40% bonds. And if you're in a 401k plan or something like that, that bond portion is typically recommended by something like Vanguard's Total Bond Market. If you're buying it in the ETF form, it's BND. If you punch up your whatever you use to track stocks, type in BND and look at the maximum. Go back to 2007. If you go, I'm going to save you some time here. You can do it on your own here. But in 2007, you could have bought a share of Vanguard's Total Bond Market for $74.77. Today, it's worth $71.08. You've lost value holding it for that period of time. You've lost value in the account. Yes, it paid interest. Right?
Not including dividends.
It paid interest, right? For most of that period of time, it paid very, very low interest because the interest rates were so low. Mm-hmm. Now it's kicked up a little bit, but it's still relatively low. I think somewhere around 2.53%. Now, if you're holding that in a taxable account, if you're holding that outside of an IRA, you've held something that has declined in value since 2007, and you've been taxed along the way on that interest that you've gotten in there, right? So what do you do? What do you do for that investor who says, I still want that 40% of my account, 30% of my account, 50% of my account, whatever type of investor you are? Where do I go to find stable? Because for a long period of time, now we can earn over 5% in a money market, right? But it won't always be that way, and it hasn't been that way. There was a period of time that you were earning less than 1% in a money market. So it was very hard, if you didn't like owning the bonds, it was very hard to have it in cash when inflation was 2 or 3% and you were earning less than 1% in your money market. So here's a situation, something to rethink. And I'm not saying that everybody should run out and do this, but as you're looking to get creative, right? I do think we do need to rethink the place of bonds in a portfolio. Me personally, I don't think it's something that you can say, hey, without a doubt, I'm putting it in here, I'm setting and forgetting it. I'm always going to have this Vanguard Total Bond Market in my account. I think there's a time to own those, and you and I have talked. To own a bond fund, I think the time to own it is especially when interest rates are falling, because those bond values are now coming back up. So you could get the benefit of those rising values. But what if you looked at that fixed income portion a little bit differently? And maybe that fixed income portion wasn't actually in that account. An example would be a cash value life insurance policy. Now, before people run to the exit, hear me out a little bit. So if you take a traditional whole life carrier, let's look at like a One America or a Lafayette Life, something like that, Mass Mutual. If you're looking at that, and we take a look at some of their core whole life products, you're looking at a rate of return, a compounding rate of return of somewhere between 3.5% to 4% that you're looking at. Doesn't blow the doors off anything. But the advantage to that is you're not going to get a whole life statement that's going to go down in value. That the dividends that this is paying, and some of those companies will pay dividends of 4%, 3.5%, 4%. that is being held in an account that is not being taxed. So while I'm getting that dividend interest from that participating whole life policy, a participating whole life policy is a policy that pays a dividend. You share in the company's earnings, essentially. You share in their underwriting profit. I'm not being taxed on it. It doesn't negatively affect my tax bracket. I could get to that money in time I wanted to. That cash value can be accessed in that life insurance policy, and it comes with a death benefit. So I could consider, say, I'm saving $1,000 a month, and I want that 60-40 split. I'm taking $400 and I'm putting it into this whole life cash value policy. It's safe, it's stable. If I buy a whole life policy in the state of Ohio, which is where I am talking today, you're out there in Denver, but Colorado. If I buy one today, it's backed up by the Ohio Guaranteed Fund. So an admitted life insurance company operating in the state of Ohio must buy into this fund. Each life insurance policy is guaranteed up to $250,000. So it's not FDIC insured, but it is reinsured by the insurance industry alone, which by nature is a conservative industry. They're taking our premiums, and what are they doing with it? They're investing them in bonds. They're investing them in fixed income products to generate some sort of interest revenue that they can use to offset death benefits that happen, to pay for working capital for the company. So definitely something to consider, because I can accumulate over the course of 20 years, I can accumulate a substantial amount of cash serving as that rock portion of my account in that whole life policy. I'm not taxed on it while it's doing there. I can access it anytime. And something happens to me, I just turn pennies into dollars for my spouse or my wife or my children or the charity of my choice or whoever I want to receive that benefit. So very, very powerful tool. And also, a lot of times I'll get a client in my office who's working with a fixed budget, and they'll say, okay, I like this split. I want to be fairly aggressive, so I'm going to put 80% in stocks and 20% in fixed income or something stable. But I don't have enough money to go out there and also buy a life insurance policy. Why don't you have the life insurance policy serve as that stable? You're going to, historically speaking, you would have outpaced putting it in the Vanguard Total Bond Market by a long shot, and you would have had that death benefit that go along with it, and you would have paid less taxes. So something to consider. I think sometimes with investing we get in this channel of what is acceptable, what is the standard advice, but there are ways to get creative, which possibly puts yourself in a better situation.
Especially in 2022, a lot of people are starting to rethink the bond position of their portfolio. I think that's a good idea, because if you have the whole thought process behind like having a stock 60-40, right? The whole thought process is 60% of your portfolio is exposed to risk, and then 40% of your portfolio is going to have less growth on the good years, but it's also going to be inversely correlated to that risky bucket. So when the risky bucket goes down, the bonds go up. But the curveball that we haven't experienced in decades was inflation. So inflation last year was the thing that, quote, surprised everybody, even though with the COVID spending, like a lot of people could see inflation coming. We talked about it all the time. But like when inflation's high, it's going to drive stocks and bonds down for the same reason, because in expectation that interest rates are going to increase. So I think that there's a compelling case. Like if you're going to set up a portfolio for the next 10 years, I think there's a compelling case that we are actually in a systemically higher inflation environment, just because the inflation problem is notorious for, that's why the Federal Reserve is so like hell-bent on breaking it, is because it's a notoriously difficult problem to solve once it pops its head. So like we could have, I'm not saying like double-digit inflation or anything, but we could have 3 to 4% teetering from 2 to 4 over the next 10 years. And then that's going to be a pretty nasty environment for bonds when the 20-year treasury is paying like 4%. Like who's going to own a treasury when your best case scenario is you're going to lose to or barely outpace inflation? It's like, that's not a scenario. And then you still take on the risk of, I could have nominal losses of like 30 to 40% on these fixed income positions. So, I mean, like it's definitely prudent for investors to rethink that portion of their portfolio. And I think the solution you laid out is definitely an option that people could look at, because it's just, you have to take a look at your entire portfolio and not just your brokerage account. Like you have to take a look at your entire financial picture.
Yeah, if there's one caveat to doing it that way, it's that you have to qualify for life insurance. So not everybody can get life insurance based on their age, based on their health condition, and it's not a fit for everybody. I mean, life insurance is not a it's a long-term investment. Like I would say, I would not enter a life insurance policy unless I plan on holding it for 20 years, because it's front-loaded. In the beginning, the cash value begins to build up a little bit slower. Towards the end, it grows quite quickly. But it's those first 5 to 8 years where the cash value is not as fast building up. I mean, my personal opinion, like I can't stand. I have no problem losing value in my stock portfolio. I cannot stand losing value in a bond portfolio because that I'm already taking on less growth ability by being in those bonds. And if it's not doing its job of remaining the rock of my portfolio, then I'm looking for other solutions. I mean, and where do you go to? Do you go to cash? Right now we're in treasury bills. You can't go to things like precious metals. Precious metals are great as a part of a portfolio, but they're even more volatile than stocks from a price fluctuation.
Sure. Yeah. I mean, that's like not to go down like a Bitcoin thing, but it's like that's one of the things that a lot of like the Bitcoin people are saying is like there's going to be a certain amount of people that are there's people that are rethinking the bond portion of their portfolio right now, and regardless, and it's like that capital is going to move somewhere else. Like it's not going to stay in cash forever. Like right now, yeah, you can sit in cash, but I mean, if you look at the long arc of the recent, like the most recent century that we've been in, it's been lower rates. They raise rates until something breaks, and then they have to cut them lower than they cut them before. I mean, those trends are really hard to buck. So, like if you just carry out the pattern and kind of like see this through to its logical conclusion, there's a real argument for we have to do something with at least a portion of this bond portfolio, and then some of the Bitcoin people are saying some of that capital will flow into Bitcoin. Another thing about life insurance, I would say, is that it's not contributing to an investment account per se, where it's like if something happened, you could stop. Like you have to keep paying the premiums. So that's
Sure.
one difference, I would say. The difference you said about having to qualify, that's definitely a difference. But I think in general, for most people, like if you have a family especially, you should have life insurance regardless, and you can kind of kill two birds with one stone. That the point you always make about life insurance is like it's completes the financial plan. Like so we sit with people, build a financial plan. This is what it's going to look like over 40 years. It's like it completes that in a worst case scenario where it's like if something unexpected happens, at least you can sleep at night knowing that the financial side of things will be taken care of. That's kind of what life insurance does. So it kind of kills two birds with one stone. If you're talking about you have access to that money, it's a stable part of your overall portfolio that's going to give you steady growth, and then also gives you some peace of mind. So I think it's definitely an option that people could look at for sure.
Yeah, it's a self-completing nest egg, essentially, is what it is. In the event that I don't live that 40 years, my wife gets what I could have accumulated over that time anyways.
Sure.
Way off topic, but I heard somebody say something. You know how somebody says, all things in moderation?
Mm-hmm.
You've heard that before. They added something to that. They said, all things in moderation, even moderation. I thought about that and I was like, that's actually brilliant.
Yeah,
because if you look at life, like all the processes of life are never balanced. Never. People always say, go live a balanced life, right? You have to have balance in your life.
That's boring.
You have to have variety in your life,
yeah,
right?
Yeah.
I can't be all work and no play, and I can't be all no play or all play and no work.
Mm-hmm.
But like even look at the process of walking. The process of walking requires you to intentionally put yourself off balance so that you're falling forward and you catch yourself with the other leg, and you do it again and again and again. So I think about that. Like you could use moderation as an excuse, whether that's the way you work out, whether that's the way you approach your job, your relationship, whatever that might be. But when things are actually achieved and went after, it's in that sprint, right? Like, so right now, Derek, you are studying for the CFA, which is an incredibly hard accomplishment to get. That is at a minimum a 3-year commitment to studying your butt off.
Yeah. Hours a day.
That is not moderation.
Sure.
But you're not going to be able to achieve that CFA through moderation.
Mm-hmm. Yeah, I mean,
So
nothing worth going after or nothing worth achieving is achievable through like mediocre work. That's what makes it so special when you actually achieve those things.
Yeah. So not anything that we need to talk about. I just thought that was brilliant because sometimes, we have an audit or something where we got a big client coming in and, I'm running on 3 hours of sleep and somebody will say, hey, you got to get your rest. It's, that's going to hurt your health. Yeah, it will hurt my health if I did that every night, but it's not going to hurt me that one night. And it stretches you. I mean, if you look at things in life where you're pushing that envelope, whether it's through your exercise, there's sometimes I go through exercise routines that are grueling for 2 or 3 weeks. Not something that I could probably keep up for a year straight, but in that 2 to 3 weeks, a lot seems to be gained, and I feel good about it.
So you read Jordan Peterson's 12 Rules for Life, right?
Mm-hmm.
Yeah, so that's kind of like the thesis of it. If you want to boil down his thesis of the book, it's that basically meaning in your life is found at if you think about it like an efficiency curve. So it's like you can operate, your most efficient outcome is like operating within your means, but at the very edge of it. So you want to operate at the very edge of what you're capable of, and you want to basically like find that line of efficiency where it's like if you push yourself too hard, it's unsustainable and you're going to crash. And if you don't fulfill your potential, it's like you're going to lead a life of misery. So it's basically like push yourself to the absolute limit of so you know what you're capable of. And if you can find that level, that's where the most meaning in your life is found. So just to kind of give an illustration of the point you just made.
Yeah. Vince Lombardi said that, I'm going to screw it up, but basically man's greatest moment is that moment where he's lying exhausted on the field of battle, victorious. Like you've given every ounce of what you could possibly give and it paid off.
And it was worth it. Yeah.
And it was worth it. So you're never going to find that sitting on the couch eating a bag of potato chips.
I don't know. It depends how good the potato chips are.
What else you got for us, Derek? Anything?
Yeah, sure. We can end. So I said I was going to give a bullish take and a bearish take. I gave my bearish take. So my bullish is, I don't think you're on board with me yet, but I'm like getting more sympathetic to the idea of buying PayPal stock. So there's a lot of reasons why I think PayPal stock is a buy at close to like $50 a share. So right now it's trading around like 60, 61. And I'm of the view that just because of in a bear market event, in a credit event, in a recession, kind of all correlations kind of go to one where people just look to raise cash and sell anything that they can. So I don't want to like give off the impression, like you called me a perma bear. I don't want to give off the impression that I'm like Chicken Little and like next year I'm calling for the market to get cut in half. I don't think that's going to happen. I just think that we're due for a larger pullback than normal, just like normal market functions. And I think it's going to catch a lot of people off guard. And usually when those types of events catch people off guard, it's usually worse than what you expect it to be. It's not going to be 2008, but it's going to be worse than people expect it to be. It just always is. So that's my general thesis. So anyway, so going on with my PayPal thesis. So PayPal's at around $60 per share. I think it's a buy now. I think it's a bargain at 50 to the point where I would buy it. So PayPal has made a lot of like bonehead decisions with like they're getting into like the censorship game where they're saying like they're working with, I think it was the ACLU to like limit accounts that are deemed hateful. And like
Sure.
The ACLU has a terrible track record of determining like who's hateful. Like obviously they'll include like neo-Nazis, but they'll also include people that just say stuff contrary to the prevailing narrative. So like idealistically, like PayPal has done a lot of stuff that I get if you would never want to touch a stock again. But so just from a performance perspective, just from a fundamental performance perspective, so PayPal has like kind of shifted their focus, at least looking at the numbers, not so much the narrative. They basically started to transition from a high growth, low profitability company to a low growth, high profitability company. They've increased their margins like clockwork. Their operating margins have grown 17% just since last year. They're trading at 15 times free cash flow and 14 times earnings. So that's going to be pretty cheap, especially you compare it to something like, compare it to itself. So when it was at fever pitch at $300 a share, it was like over 100 times earnings. And again, regression to the mean, it always overshoots. But if you compare it to its peers like Block, formerly known as Square, Block has negative free cash flow, negative earnings. Their revenue is flatlining, negative operating margins, still trading at 20 times next year's earnings. PayPal's trading at 10 times next year's earnings. And then if you compare it to something like in a similar realm, not apples to apples, but compared to like a Visa or a MasterCard. So Visa and MasterCard have higher margins. Like those are notorious. Like those are incredibly profitable companies. Yeah, but those stocks are also way more expensive. So if you're looking at an outperform, like to compare those three stocks, if you were going to guess which one would outperform, I think you could make the case for PayPal just because you would be buying it at such a discount. But I mean, if you're talking about the fundamentals of the business, I mean, I would be very happy to buy Visa or MasterCard just because of how profitable those companies have been for their entire history, and they just become more and more profitable every year.
Yeah. One thing I like about PayPal, so it wasn't too long ago, Derek, that PayPal was one of the darlings of the fintech, right? I mean, every month this thing was just shooting up, ratcheting up. A couple months ago, PayPal sold some debt that they had. So I don't know if it was like cash advances or what was going on, that they were owning some debt that they were making money off of, but they basically said, this is really not the business model we're after, right? Because when things turn south for the economy, we're not sure if we want to be holding this debt. And the debt that we're holding is not the greatest creditworthy debt out there, right? So they offloaded some of that debt. So I applaud them for that and looking at their business model and saying, hey, this is great. We made some money off it, but long-term, this is not who we want to be. The negative thing that I have about PayPal is that my concern is what you just led into is, like when I look at Disney, I look at a company that's lost.
Anheuser-Busch.
Anheuser-Busch. Well, Anheuser-Busch,
made a mistake.
Without getting into that, they made a mistake by not knowing who their customers were, right? And that was the mistake by alienating their customers, people who actually buy and drink their beer, or at least did. Disney concerns me a little bit because it seems to be a company that's maybe not as concerned about making money as it had been in the past.
Yeah.
And if I'm an investor, and this is my personal opinion, I'm not saying everybody should do this. I'm worried about a company making money. I mean, call me old-fashioned. Leave the morals to myself. I'll have my own morals and I'll raise my kids that way. I don't need the corporations to do that. I need the corporations to make money and sell the products, make amazing products that people want, make them honestly, make it something that I can stand behind and be proud. But I don't necessarily have to have them teaching my kids what is right or wrong. So that's my concern about PayPal, is when they got into that censorship, I started scratching my head and saying, is this actually what I want out of a company? Or do I want them to make an amazing product that people want to use? And they do have a great product. Like how many times have you Venmoed somebody?
Venmo is
use PayPal.
wonderful product, yeah.
So I'm with you. I would actually say PayPal, I think, is probably a buy. I would agree with you. You'd have to decide, though, if that's a company that I would want to see continued effort from PayPal to see that they're in the business to be profitable.
Yeah, I mean, and the thing is, it's like Disney is the best example of this. Disney is literally the best example of this because it throws like the whole notion of like just buy and hold, like completely throws like cold water on that idea because if you would have held, let me just pull it up so I don't say anything wrong. If you would have bought the stock in 2014, so buy and hold, so that's almost 10 years, you would be flat on your investment. They used to pay a dividend. It was like 1%. Now they don't pay a dividend. So, I mean, that's the type of stuff that you're looking at. Like, so when people say buy and hold, you have to make sure that the reason that you bought the stock is still true. So the reason you bought Disney stock in 2014 was the catalog. They were, I don't know what they had owned at that point. Because they bought like ABC, ESPN, like the Star Wars. They bought all this stuff, Marvel in the meantime between those two. And then if you would have bought it under those circumstances, you would have been like, oh, this company is going to be insanely profitable. They're making good acquisitions and all this stuff. But now it seems like just after bomb after bomb after bomb, like when they're making these movies, it just seems like they are not listening to the consumer at all. And so to your point about like, it's not the company's job to input or to have a moral discussion about whatever. That's the consumer's job. The consumer votes with their dollars. If they say, so the company is like polluting lakes and rivers, and then the consumers are like, I don't want to support that. I'm not gonna do that. So like that's the consumer influencing the company. But when the company is doing top down, saying like these are the things that we support, because I mean, if we're like hiring from these universities and like these like up and coming generations are saying that this is the type of stuff that we want to push on the consumer, it's like that's not going to work, and it's going to backfire on you every single time. And that's like, not to bring up Anheuser-Busch again, but that's what happened with Anheuser-Busch. And like they're paying for it royally right now, where like Bud Light isn't the top selling beer anymore. And I mean, there's not really a clear path for that to return, like, because like it's like rock and a hard place where it's like Bud Light's not going to admit they were wrong, and the consumer is just like, there's a million other options. It's just like, I just don't have to buy that specific option. And it literally has like people aren't even paying attention to like they're just saying Bud Light, you know, it's like they're still buying other Anheuser-Busch products because they own like 50% of the beer market or something like that. But it's like the company should be focused on making money and leave the morality decisions to the consumer. And that's the whole thing, like why there was such big backlash against the ESG stuff, is because the companies were saying, these are the types of stuff we believe in, and you should believe them too, or you're a bad person. And it's like, it's just not going to work.
We need to talk on a future podcast. I know we've gone long today, but it's an interesting flip that BlackRock has done on ESG in regards to Bitcoin as well, right? Because now they have a potential Bitcoin ETF coming out, and all
it's in their interest.
Right, it's in their interest, and all of a sudden, Bitcoin doesn't sound so bad. Bitcoin's not so bad for the environment. I don't know. Yeah, it's you know, I'll leave this with the Anheuser-Busch is a lot of people I talk to, and I would probably be included in this, when they did the can, right? They sent the can out. I didn't think twice about it. I didn't really think about it. But then they had this reaction to it, right? And I talked to people who don't buy Bud Light, not because what they did angered them or offended them, but it was now an opportunity to basically, for lack of better words, give the middle finger to these companies who are trying to push their agendas on the consumer, right? Mm-hmm. It didn't offend me, but I'm still not buying your beer because I don't think that you should be deciding what is right or wrong. To your point, the consumer can decide what is right or wrong.
They were made an example of, I think, is the main thing. It was just such a like primed target for them to attack, because it's like the only people that buy that beer are like, I mean,
sure,
I'm making a generalization, but like working class, like that's who would buy Bud Light. And then it's like, they're basically saying like, we want to change our brand because the people that buy our beer suck. It's like fratty. That's what they said. It's like, well, then screw you. It's like, well, then I just won't buy it. And it was just like a perfectly aligned target, and it was just a kill shot because, like, I mean, you literally couldn't have had a bigger blunder if you tried. Like, it was just like basically saying we don't want 90% of our customer base to buy the product anymore. It's like, what do you think's going to happen? Yeah.
Well, and the sad thing about that is what's missed on that is decreased in production, which leads to those blue-collar workers who are working for Bud Light, making their beer in the factories, who are losing
probably
jobs.
Good jobs. They're probably good jobs.
Good jobs. Yeah. Because of a decision that was made at the top, right?
By some
not even the top, but
just
a
marketing. Yeah, right. Yeah, exactly. You're right. Yeah.
So, all right, Derek, where can people find us on social media or anywhere?
As always, thanks everybody for listening to the podcast. If you liked it, like, share, subscribe wherever you get your podcasts. Follow us on Facebook, Instagram, LinkedIn, YouTube at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact. And we'll see you guys next week.
Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Florida, and Texas. At any time, you can request our forms ADV-2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today in the show, Derek and I talked about specific investments, and that is not a recommendation for you to buy them or sell them. Do your own homework and make sure they are suitable for you. Keep in mind that investing is a process that involves risk, including the potential loss of principal.